Everyone can justify a trade ID, but very little people actually know when to trade and on which days and weeks to get involved. The people that know when to trade are the real professionals. If you know when to trade, you are ahead of 99% of your competition. In order for us to be professionals, there needs to be a boundary before we look at the chart. Just like there needs to be a boundary before we go into the lower time frame. Otherwise, we can justify a trade ID every single day. So to create a boundary, we are going to go over low probability conditions and then also high probability conditions. Low probability conditions. Again, when I talk about probabilities, you need to remember, I am truly talking about probabilities, not a binary thing. What I mean by that is a binary is it's on or off. Low probability, there's a 20% chance on that day that you will win. So there's still a chance that you will win, but are the odds in your favor? No. High probability conditions are very easily summed up. High probability conditions are clear one-sidedness. Now, let's try to define this. If we are looking at GU right here, and we are coming above that high right there. Clear one-sidedness is when you can only make arguments on one side of the market. And you can watch the free weekly forecast because we exactly called this move. Right there, at that moment in time, there are only bullish arguments to be made right there. There is nothing from a probability standpoint. There are no bearish arguments to be made right there from a probability standpoint. There's no bearish fair value gap lower. There's not even a sweep of that high. There's not an order block lower. There's nothing bearish about that price action. There are only bullish arguments to be made. That is exactly when you want to be looking at the market or at any market you are trading. When there's clear one-sidedness. So again, clear one-sidedness is when you can make only arguments of one side of the market. Now, is that going to be all the time? No, it's not. And that's exactly why we have high probability conditions and low probability conditions in the first place. It's not always going to be a high probability condition, otherwise it wouldn't even be a high probability condition. But in those high probability conditions, you might have a win rate of maybe 80, 90% with crazy returns. Because if you know where the weekly like this will expand, then imagine how much profits you can make on the lower time frame by just knowing where the weekly will likely head towards. A high probability condition like this, based on price action alone, will absolutely scream at you. You don't have to force it. When I went into the chart at this moment in time, it only took 2 seconds for me to realize that is a high probability condition. And this is a general rule of thumb that I use in every major decision I need to take in life or any small decision, any decision you can think of. If you need to convince yourself to do something, then don't do it. Now, how does that relate to trading? If you need to convince yourself of certain price action, then don't trade it because most likely you are forcing it and most likely that is not what you want to be trading. If your intuition is taking over, etc., then that setup will be so stupidly obvious. Whenever you're trying to get to a drawn liquidity, the drawn liquidity should be so stupidly obvious like this, especially after this candle, after that down candle. What will the next candle likely do? It will move higher. There's no bearish arguments right there to be made. It's so stupidly obvious that this was the first drawn liquidity. So stupidly obvious. So when you demand this off of price and price delivers exactly to your demands, that is already high probability conditions. So the highest probability condition is demanding something off of price and price doing exactly what you demanded off of it. Because then you already have set out in your mind certain guidelines that price needs to follow and that you need to follow when price does deliver on that. So you already have made up in your mind, if price does this, I do this. So you have an if then. There's no emotions involved or whatever. That is exactly what you want to have. And that's the same premise when you open a chart and within the first 5 seconds, you can already tell, I like this. That is exactly when you want to trade it. Because at that moment in time, there are no emotions involved. When you're trying to force it, you're trying to force in low probability conditions. There are emotions involved. There's ego involved. That is detrimental. So I always tell my mentorship, I can tell in 10 seconds whether I want to trade a certain instrument or not. If there's nothing clear to me within that first 10 seconds, then I don't like it. Again, that's a general rule of thumb for me. 10 seconds is of course a bit of an exaggeration, but 1 minute maximum. If I can't get to a clear drawn liquidity within 1 minute, then I don't trade it. That's as simple as it is. I don't force anything. A similar scenario right here on USD Canadian dollar. When we came into that weekly fair value gap right there, overlapping with the mitigation block right there, and we already had a huge rejection down, then this next candle is so stupidly obvious that I want to trade towards that swing low right there. That is exactly the type of conditions that you want to have. So low probability conditions are exactly the opposite of course, high probability conditions. If you can't get to a clear drawn liquidity, there's no clear one-sidedness, then you might have a 50-50 bias. Let's define a 50-50 bias. A 50-50 bias is when you have both bullish arguments and bearish arguments. Whether you have 90% bullish arguments and 10% bearish arguments, that is still low probability conditions. High probability conditions is when you can only make arguments to one side of the market. You want to have 100% bullish arguments and a 0% bearish arguments to take longs. For example, right here on the dollar, we had this as a drawn liquidity. And when we took out that drawn liquidity, we had an immediate rejection right there, higher. And based on the fair value gaps telling me a story video, we know that this order block with that fair value gap should ideally immediately push price lower. And we shouldn't sweep that if we want to continue lower, of course. Then afterwards, what do we see? We don't see a rejection lower. We slowly climb lower. We slowly climb higher. So let's look at the arguments. Overall, we have been bearish, but we are sweeping that low. We are not following through to the downside, but overall we are bearish. So right there, we have around 70% bearish arguments and 30% bullish arguments. That's a 50-50 bias. That's not a high probability condition. And you can see this PD array, premium arrays right there, not following through, not showing fair value gaps lower and taking out that new low. That leads to your seek and destroy conditions, which is something we will go over more in depth in the next video as well. When we look at this price action, what did we have? We had an expansion right there going into a consolidation right there. Here the consolidation is a few candles. This consolidation, expansion, consolidation concept also applies to only your singular candles. So that is 3 candles. Consolidation, expansion, consolidation. That consolidation creates your first candle of a potential fair value gap. That expansion creates the second candle of the potential fair value gap. The third candle will confirm the fair value gap. What do I mean by this? When we look at this price action right here, we have 1, 2, 3. That is the main premise behind it. Again, that first consolidation can also be an expansion, but it's being aware that this last candle right there, that third candle, that is the dangerous one because that one is unpredictable. Now, the last general rule of thumb that you need to use to identify low probability conditions is when we have had a major expansion to either side and we have taken a drawn liquidity, exactly what we're seeing here. We have had expansion, expansion, expansion. We have taken the drawn liquidity. That is exactly a low probability condition. Same for the most recent week when I'm recording this video actually. We have taken that drawn liquidity to the left in the form of that low right there. This right here was also low probability condition for me. Taking shorts right there was also low probability condition for me. Right there, I would prefer taking longs because we had a huge expansion and we had taken the drawn liquidity. But again, that is where you need to be careful that you are not trying to call a bottom. So you wait for clear bullish price action based on the higher time frame, 4 hour and above. When you're trying to chase price after a big expansion or trying to call a bottom or a top, that is exactly low probability conditions. A few other low probability conditions for me are on the day itself, trading ahead of CPI, FOMC, and NFP. Because for me, it usually consolidates ahead of that time, ahead of that major news release. Of course, we talked about the news events. The other news events are perfectly fine. They are tradable to me. It's only CPI, NFP, and FOMC. If I want to trade on that day, I want to trade after the news release. Trading ahead of those news events, CPI, NFP, and FOMC, is low probability for my trading model. It might not be low probability conditions for your trading model. And that is where data comes in. You collect data, and over 100 trade sample size, you look at the trades and think, all right, from these 100 trades, I can now gather great information on my low probability and high probability conditions. If I see my win rate is significantly lower trading ahead of CPI, trading ahead of NFP or FOMC, then that exactly is your low probability condition. But my data is not your data. So that is where the difference comes in, and that is where you need to do your own work because you have a unique individual trading model. We went over high probability conditions and low probability conditions for trending models here. This seek and destroy profile right there is someone's high probability because someone has a seek and destroy trading plan. You either have a trending plan or a seek and destroy trading plan. There's no in between. And you only need one of them. That is what I would advise. Focus on one of them. So in the coming episodes, we will exactly discuss how we can form a trading plan in seek and destroy conditions. If you haven't watched the video on where we go in depth on news just yet, I would highly advise to watch that video. You can click on it right there. All right, perfect. Thank you.